You know, most people think Benjamin Graham taught people how to pick stocks. That's what his books are famous for. Numbers, ratios, balance sheets, margin of safety. But if you read between the lines, if you really understand the man behind the formulas, you realize something much deeper was going on. Graham was not teaching people how to get rich. He was teaching them how to stop being controlled. Benjamin Graham was born in 1894 and lived through events that broke people psychologically. He saw fortunes vanish overnight. He watched intelligent, educated men panic, lie to themselves, and follow crowds straight into financial ruin. He lived through the Great Depression, when money disappeared, jobs evaporated, and fear became a daily companion. And from that chaos, Graham formed a philosophy that had nothing to do with greed and everything to do with independence. Here's the uncomfortable truth most finance channels won't say out loud. Money does not change who you are. It reveals who you are dependent on. If your income can be taken away by one decision that isn't yours, you are not free. If your lifestyle depends on constant approval from a boss, a client, or a market you don't understand, you are not wealthy, no matter how impressive the numbers look on paper. Benjamin Graham understood something that most people miss even today. The real risk in investing is not volatility, it's emotional dependence. The moment you need an outcome to happen, the moment you rely on the market to behave in a certain way so you can survive, you stop thinking clearly. You stop acting rationally. And once rationality is gone, no strategy can save you. Graham saw this firsthand. Investors didn't lose money because they lacked intelligence. They lost money because they lacked discipline. They needed prices to go up. They needed approval. They needed certainty. And the market punished that need mercilessly. That's why Graham introduced the concept of the margin of safety. Most people think it's just a financial buffer. Buy cheap, leave room for error. But psychologically, it meant something far more powerful. It meant structuring your life so you don't need things to go right immediately. So you don't panic. So you don't beg. So you don't compromise your judgment just to survive. Think about how most people live. They wake up already behind. Bills waiting. Expectations pressing. Decisions forced. They don't ask, is this smart? They ask, will this keep things going one more month? That mindset infects everything. Careers chosen for security instead of fit. Investments chosen for excitement instead of value. Relationships maintained out of fear instead of respect. Graham's investing philosophy was a quiet rebellion against that way of living. He believed the intelligent investor is not the one who predicts the future correctly, but the one who structures their finances so they don't need to predict the future at all. That idea is radical even now. The stock market, Graham said, is there to serve you, not instruct you. Most people reverse that relationship. They wake up and ask the market how they should feel today. Green means confidence. Red means fear. But Graham saw the market as emotionally unstable, like a partner who panics one day and celebrates irrationally the next. If you let that partner control your emotions, your decisions will always be reactive. And here's the twist most people don't expect. Graham wasn't against ambition. He was against dependence disguised as ambition. Chasing wealth for status turns you into a caretaker of appearances. Bigger house, nicer car, higher income, but less freedom to say no. More to lose, more to maintain. More people whose opinions suddenly matter too much. Graham's ideal investor was almost boring by modern standards. Calm, patient, independent. Someone who didn't need the market to validate them. Someone who could wait while others rushed. Someone who could walk away while others chased. That temperament didn't just protect money. It protected character. When you don't need fast results, you stop lying to yourself. When you don't need approval, you stop pretending. When you don't need to impress, you start thinking clearly. This is where finance quietly becomes personal philosophy. Graham believed that the greatest enemy of the investor is not the market, but himself. And self-control, he argued, comes from preparation, not willpower. You don't become disciplined in the moment of crisis. You design your life so crises don't force bad decisions. This is why Graham warned against speculation for people who needed money in the short term. Not because speculation is always wrong, but because needing an outcome destroys judgment. The moment rent depends on a trade, the trade owns you. Let that sink in. Most people aren't investors. They are emotional participants. They react. They hope. They fear. They confuse activity with progress. Graham wanted people to step out of that cycle entirely. He believed wealth should act like insulation, quiet, protective, unnoticed. You don't brag about insulation in your house. You notice it when the storm comes and you're still warm. The real benefit of investing, Graham believed, was not luxury. It was optionality. The ability to wait, the ability to refuse, the ability to walk away from bad deals, bad employers, and bad pressure without your life collapsing. That's independence. And independence changes how you deal with people. When you don't need a paycheck urgently, you stop tolerating disrespect. When you don't need validation, you stop performing. When you don't need fast returns, you stop gambling with your future. This is where Graham's ideas quietly intersect with human psychology. People who are financially dependent accept things they know are wrong. They accept unfair terms. They accept incompetent leadership. They accept anxiety as normal. Over time, this erodes self-respect. Graham wanted the opposite. He wanted investors to build financial structures that supported dignity, where decisions are made from logic, not desperation, where patience becomes a weapon instead of a weakness. The irony is that this approach often produces better financial results anyway, because calm thinking outperforms emotional thinking over long periods, because discipline beats brilliance when brilliance panics. Because avoiding big mistakes matters more than chasing big wins. But Graham didn't frame this as motivation. He framed it as reality. Markets will test you. People will pressure you. Fear will whisper shortcuts. The only defense is preparation. This is why Graham emphasized conservative assumptions. He didn't assume perfect growth. He didn't assume friendly markets. He assumed uncertainty. And instead of trying to eliminate uncertainty, he designed strategies that could survive it. There's a lesson here far bigger than investing. If your life only works when everything goes right, it's fragile. If your finances only work when markets cooperate, you're exposed. If your confidence depends on constant success, it will collapse under stress. Graham's philosophy was about building lives that bend without breaking. And that brings us to the most misunderstood part of his legacy. Graham never promised freedom tomorrow. He promised freedom eventually, if you respected reality today. Slow accumulation, rational expectations, emotional restraint. These weren't sacrifices to him. They were the price of independence. Most people reject that price. They want speed. They want excitement. They want certainty. And ironically, they end up with anxiety, dependence, and regret. Graham chose a quieter path, one where money became a tool instead of a master, where patience replaced prediction, where independence mattered more than applause. And once you see investing this way, you can't unsee it. Every financial decision becomes a question of control. Does this increase my ability to choose? Or does it tie me tighter to outcomes I can't control? That question changes everything, because wealth without independence is just responsibility without power, and money without control is just another source of fear. Benjamin Graham didn't teach people how to beat the market. He taught them how to stop being beaten by their own emotions. And in doing so, he quietly offered something far more valuable than money. He offered a way to live without needing permission. Once you understand that, a strange shift begins to happen. You stop asking how fast you can grow your money and start asking how safely you can protect your judgment. That may sound subtle, but it's the dividing line between people who build lasting independence and people who spend their lives reacting. Benjamin Graham knew that markets are not just systems of exchange, they are systems of temptation. Every price movement invites emotion. Every headline invites urgency. Every success story invites comparison. And comparison, more than ignorance, is what ruins intelligent people. He watched investors abandon sound principles not because they were wrong, but because someone else seemed to be winning faster. That pressure to keep up creates a quiet panic. It pushes people to abandon patience, to accept risks they don't understand, and to tell themselves stories that justify reckless behavior. Graham saw this pattern repeat again and again, across decades, across generations. This is why he insisted that investing is not about forecasting the future. It's about preparing for disappointment. The investor who survives is not the one who predicts growth accurately, but the one who can remain rational when predictions fail. Think about how uncomfortable that idea is. It removes the fantasy. It removes the illusion of control. It asks you to accept uncertainty and still act intelligently. Most people would rather believe a convincing story than face uncertainty honestly. Graham refused to sell stories. He sold discipline, and discipline, when applied consistently, does something profound. It slowly shifts your relationship with fear. When you don't rely on perfect outcomes, fear loses its leverage. When you don't need immediate success, pressure loses its voice. When your lifestyle isn't built on fragile assumptions, anxiety stops running your decisions. This is where money begins to change how you live. Not by increasing pleasure, but by reducing fear. Graham understood that fear is the hidden tax on human potential. People don't fail because they lack ability. They fail because fear narrows their choices. Fear makes them short-term thinkers. Fear makes them tolerate situations they should leave. Fear convinces them that stability is safety, even when stability is slowly suffocating them. Financial independence, in Graham's worldview, was never about escaping work. It was about escaping fear-driven decisions. That's why he disliked leverage. Borrowed money amplifies returns, but it also amplifies fear. The moment debt enters the picture, the timeline shrinks. The future becomes urgent, and urgency is the enemy of good judgment. Graham preferred slow, steady accumulation because it preserved psychological freedom. You could wait, you could think, you could say no. Those abilities mattered more than squeezing out extra percentage points. This perspective also explains why Graham believed most people should not try to beat the market. Not because they were incapable, but because the emotional cost was too high. Constant decision-making under uncertainty erodes clarity. Most people end up exhausted, second-guessing themselves, and chasing outcomes rather than building foundations. The irony is that people who chase excitement in investing often live anxious lives, while people who accept boredom often live free ones. Graham's own life reflected this. He experienced both spectacular success and painful loss. He was not immune to mistakes, but what separated him from others was how he responded. Loss didn't push him into denial or revenge trading. It pushed him back to principles. He treated investing like engineering, not gambling. Build with margins. Assume failure. Respect limits. Test assumptions. And above all, remove ego from the process. Ego is expensive. It wants to be right. It wants to be admired. It wants to tell a story where intelligence guarantees success. Graham rejected that fantasy completely. He believed humility was not a moral virtue but a practical necessity. The market doesn't care how smart you are. It doesn't care how confident you feel. It only responds to reality. And reality is often slower, messier, and less dramatic than people want. This humility extended beyond investing into life itself. Graham believed that people overestimate what they control and underestimate what they tolerate. They imagine freedom as an event instead of a gradual shift. They wait for a number, a milestone, a finish line, while missing the daily choices that quietly shape dependence. You don't wake up one day and suddenly become independent. You drift toward independence through thousands of small decisions, spending less than you earn, avoiding unnecessary obligations, saying no to things that complicate your life without improving it, choosing stability over excitement, choosing clarity over speed. These decisions are not glamorous. They don't make good headlines. They don't attract attention, but they compound. And compounding is the real secret Graham understood better than most. Compounding money is powerful, but compounding behavior is unstoppable. Every rational decision makes the next rational decision easier. Every moment of patience strengthens future patience. Every refusal to panic builds confidence that doesn't depend on outcomes. This is how independence quietly forms, not as a dramatic escape, but as a gradual loosening of constraints. At some point, something subtle changes. You notice you are no longer desperate. You're no longer reactive. You're no longer forced to accept every opportunity that comes your way. You can pause. You can evaluate. You can walk away. That's when money starts working for you psychologically, not just financially. Graham believed this stage arrives earlier than most people think. If they are intentional, independence is not binary. It's progressive. Each dollar saved reduces pressure. Each expense avoided increases flexibility. Each skill developed increases options. People underestimate how powerful partial independence can be. You don't need total freedom to reclaim your judgment. You just need enough margin to stop lying to yourself. Lying to yourself is the most expensive habit of all. It shows up as optimism without evidence, as confidence without preparation, as commitment to paths that no longer make sense. And fear is usually the reason those lies persist. Graham wanted investors to face reality directly without flinching, to accept that mistakes are inevitable, that markets are unpredictable, and that safety comes from structure, not certainty. This worldview also changes how you relate to other people. When you are not financially desperate, you stop needing approval. When you stop needing approval, your standards rise. You notice disrespect faster. You notice manipulation sooner. You become less willing to trade your time for validation. This doesn't make you arrogant. It makes you selective. Graham believed selectivity was essential, not elitist. Just as you don't buy every stock, you shouldn't accept every influence. Your environment shapes your thinking more than your intelligence does. Surrounding yourself with panic, speculation, and emotional volatility will eventually infect you, no matter how rational you believe yourself to be. That's why Graham emphasized temperament over IQ. You don't need extraordinary intelligence to succeed. You need the ability to remain calm while others lose control. That calmness is not natural. It's trained. It's earned through preparation and reinforced by independence. And here's the part that most people miss. This philosophy doesn't just protect you from losses. It protects you from regret. Many people reach financial success only to realize they built a life that requires constant maintenance, constant performance, constant compromise. They can't stop. They can't slow down. They can't be honest. Their wealth has become a cage with better furniture. Graham wanted none of that. He wanted wealth to simplify life, not complicate it, to reduce obligations, not increase them, to expand choice, not narrow it. That's why he avoided unnecessary complexity. Simple businesses, understandable assets, clear reasoning. Complexity often hides risk, and hidden risk eventually demands payment. The same is true in life. Overcommitted schedules, over-leveraged finances, overextended relationships. They all look manageable until stress reveals their fragility. Graham's answer was always the same: reduce exposure, increase margin, protect judgment. If that sounds conservative, it is. But conservatism, in Graham's mind, was not about fear. It was about respect for reality. And reality is unforgiving to people who confuse confidence with control. This is where the philosophy circles back to its core. The goal was never to dominate markets. The goal was to remain free within them. Free to think, free to choose, free to wait. Freedom to wait may be the most underrated advantage in the world. People who can wait don't get cornered. They don't get rushed. They don't get manipulated by urgency. They let opportunities come to them instead of chasing illusions. Benjamin Graham built his entire framework around that freedom. And the strange thing is, once you have it, you stop needing to prove anything. You stop competing with strangers. You stop measuring yourself against noise. Your focus shifts inward toward quality, durability, and alignment. This is where wealth finally becomes quiet. Not flashy, not loud, just steady. And that quiet steadiness is what allows you to make decisions that align with who you actually are, not who fear tells you to be. That quiet is not emptiness, it's clarity. And clarity is what most people spend their entire lives chasing without realizing it. Benjamin Graham understood that clarity doesn't come from having more information. It comes from removing noise. The noise of urgency, the noise of comparison, the noise of expectations that don't belong to you. This is why Graham believed that most investors should do less, not more. Fewer decisions, fewer reactions, fewer emotional commitments to outcomes they cannot control. Every unnecessary action increases the chance of error. Every impulsive move chips away at independence. The modern world pushes in the opposite direction. More trades, more opinions, more alerts, more reasons to feel behind. But Graham would look at this environment and see danger, not opportunity. Because an overstimulated mind cannot remain rational. And a mind that cannot remain rational becomes easy to manipulate. He warned that the market exists to accommodate you, not to guide you. But most people reverse that relationship. They let prices tell them what to feel. They let trends tell them what to believe. They let momentum tell them who they are. That's not investing. That's surrender. Graham wanted people to reclaim authority over their own thinking, to decide in advance how they would behave under pressure, to define rules before emotions arrive. Because once emotions arrive, it's already too late to negotiate with them. This is why his work reads almost like a psychological manual disguised as finance. He didn't trust human instincts under stress, including his own. So he built systems that protected him from himself. That's a lesson worth taking seriously. If you need motivation to act correctly, your strategy is fragile. If your plan only works when you feel confident, it will fail when confidence disappears. Graham believed a good financial life should not depend on moods. The same applies beyond money. When your lifestyle depends on constant effort, constant performance, constant justification, it drains you. When your self-worth depends on outcomes, it traps you. When your peace depends on everything going right, it's temporary by definition. True independence reduces the number of things that can ruin your day. That's the standard Graham was working toward. And this is where the philosophy reaches its final layer. Independence is not just freedom from others. It's freedom from your own worst impulses. The impulse to chase, the impulse to prove, the impulse to react. Most people think discipline feels restrictive. Graham understood the opposite. Discipline is what creates space. Space to think, space to choose, space to walk away. He knew that wealth pursued without discipline turns into obligation, bigger lifestyle, bigger commitments, bigger fear of loss. And suddenly, money that was supposed to free you becomes the thing you protect at all costs. That's how people end up rich but trapped, successful but exhausted, comfortable but anxious. Graham wanted wealth to act as a shield, not a spotlight. That's why he avoided unnecessary attention, why he preferred rational progress over dramatic success. why he emphasized durability over excitement. These were not personality quirks. They were strategic choices. He understood that the greatest luxury money can buy is the ability to live according to your own standards, to choose what you will and will not tolerate, to act in alignment with your values even when it's inconvenient. But that ability has a price. It requires restraint long before it delivers freedom. It requires saying no while others say yes. It requires patience while others rush. It requires being comfortable looking wrong in the short term to be right in the long term. Most people are unwilling to pay that price. They want freedom without restraint, security without sacrifice, independence without discipline. Graham would tell you that those combinations don't exist. You earn independence the same way you earn trust, slowly, consistently, through behavior that holds up under pressure. This is why his ideas have survived crashes, bubbles, and generations of market madness. They're built on human nature, not trends. And human nature hasn't changed. People still panic. People still chase. People still confuse confidence with competence. And people still pay for those mistakes. The ones who don't are usually quiet, unimpressed by noise, uninterested in spectacle, focused on building lives that don't require constant defense. At some point, if you follow this path long enough, you notice something profound. You stop feeling the need to explain yourself. You stop needing permission. You stop measuring your progress against other people's timelines. You're no longer trying to win. You're trying to endure. And endurance, over long periods, outperforms intensity. Benjamin Graham didn't promise excitement. He promised resilience. He didn't sell dreams. He offered tools. Tools to think clearly when others can't. Tools to remain rational when others panic. Tools to protect your future from your own emotions. That's why his philosophy still matters. Not because it makes you rich quickly, but because it makes you free slowly. And slow freedom lasts. Here's the final truth he leaves us with, whether he said it directly or not. Wealth is not about how much you accumulate. It's about how little control others have over your life. It's about how rarely you're forced to act against your own judgment. If money doesn't give you that, it has failed its purpose. So build margin. Financial margin, emotional margin, mental margin. Design your life so that fear doesn't get a vote. So urgency doesn't rush you. So pressure doesn't rewrite your values. Invest the way Graham taught, not just with numbers, but with temperament, with humility, with patience. Because the real return on intelligent investing isn't money, it's independence. And once you have that, you don't need to chase anything ever again.